All right, good morning, everybody. I'm Roseanne Bump, Executive Director with FEI Twin Cities. It's great to see everybody here this morning. Our session today is on capital markets and M&A update. This session is eligible for CPE, so you need to answer at least 5 of the polling questions today during the webinar and have a total viewing time of at least 75 minutes. CPE will be available 7 to 10 business days after the webinar, and we are unable to grant CPE credit in cases where technical difficulties preclude eligibility. Before we start our session, I want to just give some upcoming session information. So we do have 2 more sessions in this series. So next Monday, we have Beyond the Numbers and M&A Transactions, the culture and people side. And then next Wednesday, we have recent developments in reps and warranties insurance and other transactional insurance considerations. On June 2nd, we have a business ethics and real world violations class. For those of you looking for business ethics CPE, this is your chance. There are 2 credits available here. And then we hope everybody will join us for our 2021 golf outing. This is our first in-person event in 15 months, so we are mighty excited about this. It's going to be June 21st at North Oaks Country Club. And then we just posted our annual meeting as well, so Twin Cities FEI. So if you'd like, that registration is open and you're welcome to attend that as well. So we're going to go ahead and get our session started today. I'm going to introduce Joe Housman. Joe is the moderator for today. Joe is Vice President and Producer at Hayes Company, Brown & Brown. Joe?
Thanks, Roseanne. Again, Joe Housman from Hayes Companies. I am a member of the FEI Board of Directors. I chair the Career Management Committee, which is all about finance executives that are in transition and looking for the next opportunity. So if you know anybody that fits that criteria, don't hesitate to give them my contact information. I have been working with Jay on this M&A series for the last couple of years and in a support role. And so I'm starting to take over a little bit more of an active role. I'll be moderating today. So as we go through the presentation, if you have questions, you can feel free to throw them into the chat function, either to the full group, or if you want to send them directly to me, then I will facilitate those questions at the end of each of our panelists' sections. Today we have 3 panelists that are going to walk through the capital markets and some recent updates in accounting and tax within the M&A environment. Alan Cannella, Vice President of PNC Capital Markets, LLC, will kick us off. And then we will move to John Kim, who's a director with the BDO Capital Advisors. And finally, Steve McCullough, a tax partner with BDO, is going to talk about some tax and accounting updates. So with that, I'm going to let each of our panelists introduce themselves as they kick off their presentation. Again, if you've got questions, feel free to throw them into the chat function on a broad basis or directly to me or Roseanne, and we'll make sure they get addressed again at the end of each of our panelists' presentations. So Alan, why don't you take it away?
Thank you so much, Joe, and thanks everybody for the time today. Really looking forward to our discussion. And I'm going to give you a debt and equity market update today, and as well as an M&A update. But before I do that, a little bit about myself. I have worked at PNC for 12 years. I am responsible as part of the team that covers Minnesota, but I am based in Pittsburgh. Really looking forward to things opening up. The last travel I had to Minnesota was in January and February of last year. So would really like to enjoy some of the better weather, hopefully later this year. But my whole career at PNC has been basically serving companies in different capacities, helping them grow. PNC is well positioned to do that. We are slated to be the 5th largest bank following our pending acquisition of BBVA USA. And I really hope you enjoy my presentation today. I wanted to give a presentation really through the lens of what we've all been experiencing over the past year. And for me, that means a lot of TV and movies that my family has been watching. So hope you enjoy a little bit of humor in my presentation. With that, we'll get started right in on the big topic of the day, and that's the vaccine rollout. So vaccine rollout and fiscal stimulus is expected to be the Witcher's potion for GDP and earnings growth. The first quarter GDP read that just came out last week basically put us back to even on a year-over-year basis. PNC is projecting that the second quarter GDP will put us above where we were pre-pandemic from a GDP standpoint. And most of the market is anticipating very positive earnings. We can see the companies that have already reported earnings have reported very strong earnings. And you can see from this slide, just the level of earnings is expected to be well in excess of pre-pandemic levels. We do believe that there's a consumer out there that is ready to consume. I know I am, probably a lot of you are as well. We're gonna go and get polling question number 1 kicked off here. And
Thank you, Alan. I will go ahead and take it from here. We're actually going to do
Thank you.
2 right away. Yeah, you're welcome. We're going to do 2 right away. So the first one is, would you like CPE for this session? So this is an easy one, yes or no. And remember, you need to do 5 polling questions throughout the session. So we'll give everybody a couple minutes or a minute or so to do that, and then I'll launch the next poll. All right, we're going to give it 5 more seconds. Perfect. And then I'll launch the second one here. All right, here is the first official poll. So when must lenders cease originating contracts with LIBOR as the reference rate? 12/31/21, 12/31/22, 6/30/23, or 12/31/23? Again, we'll give everybody a few seconds to answer that. And then Alan, I'll share the results back and you can share that with the group.
Perfect.
All right, I'm going to give about 5 more seconds. All right, and then Alan, here are the results.
All right, very good. We had around 50% with the correct answer, which is 12/31/2021 for new contracts. 6/30/2023 will be the date for any existing contracts. But pretty good response there.
Thank you.
So talking a little bit more about rates, long-term rates are peaky on inflation bets. Don't have blinders on to LIBOR replacement at the end of 2021. There was a lot of news yesterday about rates, and Treasury Secretary Yellen had some comments about rates and the potential need to raise rates maybe sooner rather than later. I think that was by the end of yesterday was really tamped down again, and we're kind of back to where we were before yesterday. And that long-term rates have risen over the past year based on expectations of growth and inflation, while short-term rates have really remained pretty low. And this has really taken the relative value in different financing alternatives from last year and really spun it on its head. So long-term fixed rates were very attractive last year. Now we're at a place where shorter term floating rates are much more attractive. And as we already talked about, there's some other facts here about what's going to go on with LIBOR replacement. I won't address that too much, but just know that right now SOFR is the preferred fallback for LIBOR replacement. Moving on to defaults. Default rates are no longer up Schitt's Creek, but corporate leverage is still high on a gross basis. Defaults didn't hit near the levels that we thought, that really anybody thought. Banks had reserved a ton of provision over the past year. They've started in the past quarter to releasing that provision, and it's really driven bank earnings higher. But as you can see from this chart, defaults really peaked in the third quarter by many measures, and right now for speculative grade defaults as well as leveraged loan defaults, those numbers are now under the historical average for those defaults. And so we do expect that corporates are in a pretty good position right now. The one wild card here, as you can see in the bottom chart, is leverage is high, but it is high on a gross basis and not necessarily as high on a net basis. So what's going to come down to is, what are companies going to use that cash that they loaded up for? Is it still going to be that extra liquidity that they got last year, or are they going to look to spend it on either CapEx or dividends or acquisitions? So that will have a big say in where defaults go from here. And, obviously depending on the overall economic backdrop, which we hope hits even that optimistic forecast. Banks are currently holding enough liquidity at the Fed to make Hamilton blush, driving appetite for loans. This is a definite reversal from where we were in the middle of last year, when a lot of companies were getting new 364-day facilities. They were drawing down on their existing revolvers, and those were revolvers that banks never really thought that borrowers would use. That was kind of that extra security blanket that wasn't expected to be tapped. So banks went from needing to be a little bit picky in how they were deploying their capital to now having a ton of capital between the repayments and certain bond for loan takeout that occurred over the course of last year. The banks are really looking to deploy that capital. There's huge demand for loans from banks. On the institutional loan market side, you can see here on the right-hand side, CLOs are the biggest purchaser of institutional term loans. And you can see that there's been an increase in CLO issuance, driving demand for institutional term loans. And there's also been good funds flow from retail investors. So think of your loan ETFs that you or I can invest in. There's also been a positive swing in that as investors have looked for floating rate instruments. Loan market terms pull a Cobra Kai, flipping the script on what we knew. Last year, if you asked me 4 different times what the tenor was in the marketplace and who the bad guy was in the Karate Kid, I would have had 4 different answers for you. So in the second quarter, we were really at a 364-day market for deals. And if you had a revolver or other debt that was coming due, you may have tried to do a 1-year extension on that because you didn't really like the terms that were out there in the market for a full tenor extension on your transaction. A couple months later, we were in a 3-year market where you could probably get similar terms to what your existing deal was, but on a shorter tenor. And there was a small gap where 4-year deals were happening. Those weren't that popular, but that was happening in the fourth quarter, once again, to retain the terms that you had in your existing deal. I would say now we're pretty much fully back to a 5-year market to be able to get the terms that you had previously. And it's really just being driven by that demand that we talked about before. Similar thing has gone on with LIBOR floors, whereas last year, a lot of transactions were having LIBOR floors as high as 100 basis points, as you can see here. We're now at much more reasonable levels. A lot of lenders in this middle market survey were saying that they would require just a 0 basis point LIBOR floor, the much more normal market. Syndicated loan volume above pre-COVID levels comes to America. The good volume in the first quarter of 2021, it started to be driven by more M&A as deals were announced late last year and into the first quarter. And it was also driven by refinancings as borrowers were more confident that if they did go to market, they were going to get terms that were agreeable to them and they weren't going to have to sacrifice terms to get an extension. Powell brings bazookas to a knives out fight, drives issuer preference for bonds. The Fed did a lot of good things last year that backed all of the markets. It made sure that almost all of the debt markets were functioning correctly. And he did this in explicitly and implicit ways. Obviously there were other stimulus that went on and continue to go on that also supported the market, but it really put the bond market in a very good place with rates that were very low, and many borrowers opportunistically went out and loaded up on a lot of that long-term fixed rate debt that, as we remember last year, was at a lower interest rate level. The private placement market had another record year last year, both in issues and in volume. So it was good to see that market continued to function as well. We have polling question number 2. Roseanne, are you going to take it over?
Yes, I will take it over. I'll go ahead and launch that. What is the level of conversations you have had on ESG lending? What is ESG lending? Lenders have raised the idea we have not explored internally. We have explored internally, but the timing is not right. We are ready to act on ESG lending financing. Leave this open for a few more seconds here. Okay, it looks like pretty much everybody has voted. I'm going to end the polling, and then Alan, I will share the results and you can share it back to the group.
All right, we have the majority, well, we have 42% say lenders have raised the idea, but we have not explored internally. 32% are wondering what ESG lending is, and about 16% have explored it, and 11% are ready to act. Thank you all for voting on that topic. Record ESG lending volume show green business is not just for the gentleman, and you can see from this chart that ESG lending is growing like a weed here. And what really is ESG lending? So in some instances, ESG lending is green bonds, green loans, social bonds, sustainable bonds that have a specific use. So the green loan, green bond needs to be used for a green use. Counter that with an ESG linked loan that can be tied to a revolving credit pricing grid, and the proceeds of that can be used for anything. So you can see in this chart that all those alternatives have been growing here, and you have a lot of options at your disposal if you want to play in the green ESG lending space. And it's just a great way. There's tons of heightened sensitivity around green and ESG topics. Blackstone, one of the largest alternative asset managers, just came out and said that they're going to be asking their companies to report on sustainability. You have the ratings agencies and institutional investors really paying attention to companies' ESG messaging. And if you do consider an ESG loan, that has some sort of link to something that matters to your company, it's a great way for your Treasury department to participate in your company's corporate social responsibility story. So we'll be happy to talk more about that if anybody has more follow-up. Bull market continues its run, but are meaty valuations leading investors to Tiger King's trap? Getting into the equity picture here, equities setting records. We all see what's going on in the news. Good earnings are really pretty much baked in here. We're sitting at a 22 times forward price to earnings for the next 12 months. And interesting to note that more money has poured into equity funds over the past 5 months than in the previous 12 years combined. So that's really driving equity levels higher. Spectivity trickles as regulators tap Umbrella Academy to protect investors from getting soaked. Sorry, spectivity threw me off there. I know there was a call on spectivity on Monday, so we won't hit this slide too hard, but just know that activity has slowed. IPO activity did slow a little bit in April as well. Just around the SPAC activity, there's been some warnings from regulators warning retail investors that just because a celebrity is involved, maybe that doesn't mean that it's a great investment, and warning investors that there is an investment period involved that could drive an acquisition, and that might not line up with what retail investors are looking for. So just gonna move on here. This is probably the reason that a lot of you are here. So marvelous M&A activity returns, poised to continue as cash piles are no joke. And the S&P 500 companies are sitting on in excess of 3 trillion of cash right now on their balance sheets. And you can see that's near record levels. And private capital is sitting on close to 2.5 trillion of cash that needs to be spent and put to work. So while we see that M&A did pick up in the first quarter, we do expect that trend to continue. Just there's that money needs to be put to use. It needs to be invested. It's not really serving any purpose right now. Companies need to put that to work. Finally, I wanted to spend some time just giving you a better sense for what your banker might be thinking whenever you bring an M&A idea to them. So some of the obvious things that you're going to think of first are, what is that acquisition going to do to leverage, and what's it going to do in relation to your debt to EBITDA, but also how much leverage are you putting on versus the enterprise value of the company? And those questions are going to drive the financing alternatives that are available to you. So just walking through some of these considerations, you really need to think about what's most important to your company whenever you're looking to line up a financing solution for an acquisition. So is additional availability or liquidity most important to you? Are you going to be using a lot of your existing cash for an acquisition, and so you need a little bit more revolver availability? Do you need a lot of repayment flexibility? Do you want a financing alternative that has less required amortization, or are you comfortable with the cash flow that's going to be generated from your company and from the acquired company, that you will be able to pay down debt pretty quickly? So you would, in that case, want a solution that is, has less prepayment penalties involved. How much financial covenant flexibility do you need to run your company? Were you up against your covenant level before you made the acquisition? And how quickly are you going to delever after you make the acquisition? Interest rates on borrowed funds, I know this is certainly a big one. The further away you get from a term loan and revolver solution from your traditional commercial bank, typically the higher interest rate you're going to pay, with an institutional term loan or any of the other possible solutions, whether it's second lien debt or subordinated debt, and you get into mezzanine financing and equity that may potentially dilute your ownership interest. The tenor of the financing that you're looking for, one thing that we like to remind companies is you may have a longer period in mind for repayment of the debt that you get for an acquisition, but you may only be able to get a 5-year financing. Well, typically, even for a 5-year financing, whenever that term loan comes close to being due, maybe 2 years in advance of it being due, there's probably going to be an opportunity to refinance that. And just another thing to keep in mind is that with a bank term loan, you're typically not amortizing that full 100% of loan amount even over those 5 years. So think about it more as not just a 5-year financing. That 5 years is really bridging you to the next refinancing opportunity. This is more for if you have a bigger issuance in mind. Let's say you have a $300 million loan need that would merit you getting either an institutional term loan or a bond. Are you trying to avoid a public debt rating that might point you more to a private placement or some of the other solutions? Are you interested in obtaining unsecured financing as part of your capital structure? That can lead to slightly better rates on your senior secured financing, but obviously you still need to keep in mind that the unsecured financing is going to be more expensive, and you need to keep leverage at a reasonable level on an overall basis. The last three here are a little bit intertwined. Lending relationships. Do you really want to keep your relationships with your commercial banks, or are you willing to deal with institutional lenders that may have a little bit less of a relationship attitude in case there are hiccups down the road? Do you want your highest attainable leverage multiple, or do you want to take the pressure a little bit further off of your company, maybe contribute equity from existing ownership, bring in a minority equity partner? Those are definitely things that you need to think about. And how much control of the company are you willing to give up if you do bring in an equity partner? Final point here is that there's this kind of myth that goes around that a lot of people that bring in minority equity into their company want somebody who's not going to bother them at all. And you really need to balance that with how much equity are you looking for. So if you bring in a partner that puts 20% into your company, they're going to want to be hands-on at a certain level. So just think about that as you think about who good partners may be. And why does your partner matter? Your partner doesn't matter in the sense of operating your company, but your partner does matter in the sense of giving you a relationship that your bank may have a relationship with that equity partner already, and they've seen how that partner acts whenever things do become difficult. And it can also matter in a sense of, that partner may have other financing relationships that they can bring to the table and actually help you get a better deal with more leverage if that's something that you're interested in. That's really all I wanted to hit on today. I do have some, just a list of financing alternatives. We won't really go through that, but let's take Q&A if people have some questions.
Thanks, Alan. I think you can leave this slide up, and if we have a minute at the end, we can address it as well.
Sure.
I do have a few questions in the chat box. The first one came early on in the conversation, and the theme, I think, was repeated a couple different times. So the high level question is, should there be concern about all the optimism? You go back to one of the first slides. I think I'm gonna maybe pile on a little bit and just think about, the macroeconomic environment. We got Bitcoin going on. I don't understand that. We've got some of the stocks that have ramped up ridiculously, right? And you've got the the individual markets that are driving some of those stock prices up fictitiously somewhat. And then the whole SPAC thing that's taken off. Then you layer on the COVID issues and all of the stimulus packages and government intervention. And I can't help but feel angst about how optimistic everybody is in kind of an unnatural, environment. So can you maybe make a couple comments about that, about how you're feeling, or how PNC is feeling about that?
Yeah, I'll more so address that from from a personal standpoint on thoughts about some of the hallmarks of of an overheated market are certainly here. You have the SPAC activity, just for example, which is certain levels make sense. SPACs have been around for a lot longer than just this year, but the level of activity and potential speculative nature of what that money, what investments in that money could be for. So I think that's one thing I'll call out, just that shows, as you get into these potentially speculative bubbles, that's a potential sign of that. Another potential sign, we're at 22 times forward earnings. Earnings estimates are pretty healthy to begin with, and we're even, at a very high level price to earnings there. I think we're starting to see some good signs in the, in economic reopening. We're seeing COVID cases go down. So I think that gives hope to the story. One thing that I do, worry about, you see a lot in the news about the inflation story, and there's still disruptions in the supply chain, obviously, semiconductors especially, and in different other parts of the supply chain. So companies are all saying the same thing. We're seeing inflation where we believe that we're going to be able to pass that on and consumers aren't going to really notice. But at what point does that run out and really, takes a toll on the overall picture? There's so much stimulus out there right now and planned stimulus that I think we're in an okay spot. But does that run out, and does the story with COVID get bad again? I think is the major wild cards.
Okay, thanks. A follow-up question to that was more on an international perspective. I think for myself, I read the mainstream media. I'm also in a lot of financial newsletters and pretty tuned into it from a U.S. perspective. So I have a decent feel on the stimulus, but from an international perspective, how is the U.S. positioned with their capital markets?
I think in general, the U.S. is positioned fairly well, comparatively speaking. I think the vaccine rollout has gone fairly well here, and just positionally from the stimulus that has been announced, I think that going into the second half of this year, the U.S. is positioned fairly well in comparison to other countries. There's going to be question marks. There's still uncertainty, but I think in relation to other countries, the U.S. is in a pretty good spot. Great.
I think maybe the last question before we move to the next speaker, to John. You got a good slide up here that walks through a number of different financing alternatives. Can you speak to a few of these, or maybe even all of them, and just in terms of interest rates, pricing, or how you do this slide?
Yeah, certainly, Joe. So it's not perfectly listed from top to bottom, but roughly from top to bottom, it's probably lowest leverage, lowest interest rate to highest leverage, highest interest rate. And I think we're all probably familiar with bank debt. Asset-based revolvers typically can have a lower interest rate than your revolver and term loan A, is because it's so collateral focused. If you do have a first in last out tranche as part of that to get more capital, that can be a little bit more expensive. Your term loan B is certainly going to be more expensive than a term loan A from a commercial bank. And if you don't meet that threshold that we talked about earlier about, you typically need about 300 million of proceeds for a term loan B. You can get a private credit term loan that's very similar and that would be unrated. Really no minimum for that, but that's going to be even a little bit more expensive than a term loan B. So let's say if you would be like a BA3 rated company getting a term loan B for the first time, you're paying LIBOR plus 350. That private term loan for a similarly rated entity on a private basis is going to be a little bit more expensive. It's going to require a little bit more amortization on that. Term loan Bs can typically be done without covenants. A private term loan is probably going to have some form of covenants. They may be less restrictive than your revolver and term loan A, but that's just something to think about there. Bond, that's going to have a similar threshold. So you may be more inclined to be in the private placement market if you're at a lower dollar amount there. So private placement typically going to be 50 to 250 million, interest rates that are a little bit higher than what you would see probably in the bond market. Second lien debt, this is going to be more useful if you do have a lot of collateral out there, or just a good collateral picture in general. But once again, I would say the second half of these, they're all going to be something above 6, 7, 8% debt rates, depending on the overall leverage picture. So you can get up into a 3, 4 times leverage picture for your company, but you are going to end up paying more for that. And then obviously the bottom, mezzanine and equity, you're starting to think about the dilution to your company.
Okay, thank you. Very informative. Thank you, Ellen. I think
Sure.
as long as we don't have any other last questions, I think it's probably good timing to hand it off to John. John, I'll let you introduce yourself and a little bit about your firm. And then just logistically speaking, I'll maybe raise my hand when we get down to like 2 minutes left in the presentation if we're bumping into time. Take it away, John.
Great, thank you. Let me go ahead and share my screen and make sure it's working properly. So again, my name is John Kim, and I'm a director with BDO Capital, heading up coverage of the Southwest region. I'm based here in Houston, and I've been involved in banking for over 16 years. Prior to my time here at BDO, I've been with Wells Fargo Securities, as well as JP Morgan Securities, and also a small M&A shop up in Chicago called Mesro Financial. Unfortunately, I don't have the entertaining TV references that Alan had in his presentation, but hopefully mine will be equally informative. And before I jump into the meat of it, I will go over the kind of obligatory commercial slides here. So I think many of you are aware of BDO. We're certainly a national firm providing assurance, tax advisory, and digital services. And we've got offices across the country with over 8,000 employees. And I think the latest count is we've got 65 and growing number of offices throughout the country. BDO Capital Advisors is a broker-dealer under BDO USA, and we are basically a full-service investment bank focused very much on the middle market. We provide the full suite of services, including both buy-side and sell-side M&A advisory, as well as various capital raises. And I promised the last commercial slide. I think a unique thing about BDO Capital is our really global footprint, meaning certainly BDO Capital Advisors here is based in the US, but then we've got partners throughout the globe who have been active in various corporate finance activities. And that's kind of one of the benefits of BDO Capital Advisors is that global reach that we can provide for our clients. Yeah. I think before we jump into the M&A market, we have our first polling question.
Perfect. Thank you, John. I'll go ahead and launch that. I have participated in blank transactions during the past 12 months, 0, 1, 2 to 3, 4, or more. Give everybody another 10 seconds or so to answer that.
Hey, Roseanne, I think this one didn't match the one on the slide,
Oh.
just in terms of number of transactions. Do we want to go back and do the other polling question at this time too?
Let me end this one. All right. Do you want me to share these results then, Joe?
Yeah, that'd be great.
Okay. All right, so it looks like 38% have done 0, 14% have done 1, 33% 2 to 3, and 14% 4 or more. All right, and then was it the level of tax knowledge? Was that the next question, Joe?
No, that one, I think that one was for Steve's section. So if we're a bit out of order, we can just keep rolling and come back to them.
Sounds good, thanks.
Yeah.
The Zoom environment, that's all right.
Yeah, welcome. Yeah.
So just very quickly, this is a kind of high level snapshot of the M&A market in 2020. And certainly I won't read all the bullet points, but I think as many of you are aware, activity significantly slowed during the second quarter. But as buyers kind of assess their own situation, look at the liquidity needs, and took whatever mitigating steps were necessary, they really did return to the table. And we saw a dramatic pickup in M&A activity during the third and fourth quarter. Now, I think what was a little bit unique is that, and some of the other slides will kind of give you some additional details, but we actually saw some valuation multiples increasing even as the overall transaction activity slowed down. And part of that is due to the fact that when the markets did open up again, the availability of good high quality assets and the businesses that ended up being pretty resistant to the pandemic, those numbers were significantly less than certainly the availability of good businesses that we saw prior to the pandemic. And so you had kind of these extremes of business owners who basically needed to sell the business because they were having significant difficulties, or we also had some very good assets, again, that were very much performed very well even during a situation like a pandemic. And you ended up seeing a lot of buyers kind of flocking to those good assets, and in that way ended up actually bidding up a lot of the valuations than you might have seen, I think, pre to the pandemic. Now, I think certainly as the economic situation continues to improve, many of the factors that make up for an attractive M&A market are essentially business sentiment, low interest rates, and readily available capital. And as you heard from Alan, interest rates still remain at a pretty attractive level and at near historical lows. And we've continued to see improvements both on overall economic performance, employment, wage increases, personal income increase, and so forth. So, this is, I think, creating a setting for a significant rebound in the M&A activity, which we've already started to see during the first quarter and should follow through to the end of the year. As I previously mentioned, the M&A market during the first quarter, we were at record dollar volumes. Anecdotally, I've heard some people comment that, hey, this seems to be close to being kind of the roaring night, the 80s, when we saw a significant amount of activity as well. And certainly the number of deals that we're seeing now compared to the lows during the pandemic, we're 2 to 3 times that. So again, I think we've got a great setup for this environment kind of following through to the end of the year and potentially even further. Just in terms of kind of the M&A, the middle market M&A activities, it's strangely enough, I think a lot of people prior to the pandemic were expecting a potential economic slowdown or even maybe a starting of a recession towards the end of 2020. But I think no one really expected a pandemic to take place, as well as the crash in the equity and financial market that we saw shortly thereafter, but then this incredibly speedy recovery that we also experienced as well. So with that, I think the overall, as expected, the overall M&A activity certainly dropped quite a bit, but we did definitely see spots of where things were looking very bright, and again, things started to, especially during the second half of last year, things started to certainly ramp up significantly. As I mentioned, the transaction volumes were certainly down dramatically if you compare it between the first half and second half of last year, and also certainly compared to the prior years before we experienced the pandemic. But again, what you saw was valuation multiples actually starting to come up because, again, high quality companies that had very proven and defensible business models remained resilient during the pandemic. And again, when things started to open up, you saw a lot of buyers, both what I would consider to be strategic buyers or public company as well as private companies, but then also some of the financial buyers kind of flocking to these assets and really bidding up some of the valuation. During 2022, I think you saw basically a decline in valuation multiples for all sectors, but some held up better than others. Certainly technology, a lot of the companies that provided some services for the audience that were stuck at home certainly did very well as we ended up seeing some of the healthcare technology companies and healthcare service companies doing very well. Particularly, one example is some of the video teledoc, those type of businesses. Certainly, their valuations held up. But I think overall, as expected, certainly valuation multiples have taken a step down. Now, as we kind of look forward, I think we'll definitely start to see a pickup in continuing with some of the technology names and the healthcare service names, but then also some business service sectors, things like kind of logistics, transportation, and some other company. As demand and consumption start to increase, I think we'll definitely see a further need for the services provided by many of the business service companies. Now, when we look at the lower middle market, and here we're looking at talking about business valuations on the smaller and less than $250 million. We saw a bump up in that 20 to 50 million as well, 50 million below type of size business valuations. Historically, you tend to see where smaller businesses garnered lower valuation multiples versus larger ones. And that tends to be the case because for buyers, the amount of time, effort, and resources devoted to going through a transaction was not that different for larger business compared to a smaller business. So oftentimes they would prefer to kind of go after a little bit larger businesses because basically they got a bit more bang for the buck. But what we actually saw last year was a bit of a reversal in that, and partly it's because people were certainly a bit more risk adverse and maybe going after some of the little bit smaller sized businesses rather than going for the larger ones. But at the same time, private equity firms, which tend to drive a significant portion of the volume for the overall M&A space, you saw them taking on more add-on acquisitions to their existing portfolio companies versus trying to take on new platform investments. So you definitely saw where kind of that 50 million and below size businesses, they ended up certainly getting a lot more attention. And with that attention and competition, certainly better valuation multiples as well. As I mentioned, the private equity firms are a very active player in the M&A market. And right now they've got probably more than 1.4 trillion of capital that they basically need to put to work. And one of the surprising things about 2020 was that private equity firms were able to continue to raise some capital, particularly the second half, and then their capital availability actually increased year over year. We ended up seeing them taking some exits kind of prior to the pandemic. Then when things opened up, some of them also took exits, which helped to kind of pad their availability of capital, even when the actual capital raising certainly had declined year over year. But we're starting to see a bit of a reversal of that this year as some of the firms that have performed well through the pandemic as well historically, they've kind of gone back and the general partners have been willing to kind of pony up again for new funds.
Hey, John, can you,
yes,
if you don't mind, can you jump back to slide 14, please?
Sure thing.
So as I'm looking at this, 2013 through 2018, it's pretty clear smaller deals are smaller rates in terms of multiples, and then all of a sudden you hit a blip in 2019 where the bigger deals are still bigger, but between 19 and 20, that I guess goes against my conventional logic and conventional thought, just in terms of rate multiples. Did you have any rationale why, or do you have any intelligence there?
Yeah, so that 10 to 25 million and 25 to 50 million, yeah, you did definitely see that being comparable to that 50 million and plus size businesses. And I believe a lot of that is, one, during the pandemic, and after things kind of opened up as the pandemic slowed down, the demand for larger businesses was a little bit down, I think, just because, kind of risk mitigation. And also, private equity firms, they were, I think, a little bit more hesitant to take on new platform investments. So would tend to be a little bit larger opportunities. And oftentimes they were on the hunt more for add-on acquisitions to their existing portfolio companies. But then also, what you, and I think a lot of experience is that there are a very large number of private equity firms that are out there. And many of them have made the conscious decision that they actually want to move down market because, historically, again, so as you pointed out, Joe, smaller businesses tend to have a little bit less competition, and they were looking to kind of take advantage of that. And with that, you saw a lot of new private equity firms again, with that focus of going after, what they would consider to be more lower middle market sized businesses.
That actually makes a lot of sense. I don't have any data to back this up, but in my network in the local area, it did seem like there were a lot of private equity firms doing more add-ons and less platforms given the environment. They kind of know what their platform business is and how to add value. It's a little bit riskier to take a new jump. And then the other observation, sometimes as you look at a slide the second time, the 10 million to 25 and 25 to 50 million jumped from 19 to 20 significantly. So it's just interesting observation. Thanks for taking a step back.
Yeah. One thing else I'll add, Joe, is that also part of it is due to, I think, sometimes the mix of the type of businesses. In 2020, again, I think a lot of the kind of technology and healthcare services was a pretty active sector. And those sectors tend to have a little bit higher valuation multiples as well. So as the mix of acquisitions kind of lean more towards and away from industrials, I think that also kind of contributed to an increase in the valuation multiples that you see.
Got it.
And as Joe mentioned, and I'm sure many of you have seen, certainly private equity firms have been very active, and in many ways, they've started to compete pretty rigorously with strategic buyers, some of the other existing companies that are out there. And again, they've got a lot of capital they need to put to work. Oftentimes, they basically need to be able to find investments and again, put that capital to work. If not, at some point, they need to kind of return that money to their investors. But at the same time, credit markets are still attractive. And as Alan mentioned, things have definitely opened up in terms of both credit availability and having a little bit less restrictive covenants with some of those new financings that are available out there. And again, with the improvement in economic outlook, economic performance, business sentiment, I think all those combined for a pretty active M&A market, and private equity firms have really geared up and continue to look for investment opportunities. And this kind of slide goes back to what we had talked about, where again, the private equity firms were very much focused on a lot of the add-on acquisitions as a way to try to better mitigate their risk. And we certainly saw a significant increase in the amount of add-ons that were taking place. Kind of, again, following back to what we mentioned prior about private equity firms having interest in lower middle market businesses, deals that were less than 100 million or so ended up making like almost 74% of total deal volume, which is an improvement of about 2 to 3% to the prior year as well. So. Just overall, in terms of what we expect to see in 2021, we really do think right now is a window of opportunity. And as I mentioned, we've definitely seen a dramatic improvement in deal flow during the first quarter. And we expect to see that kind of play through for the remainder of the year. And again, expecting overall M&A volumes to, in terms of deals, number of deals kind of returning to maybe pre-pandemic by mid-year or so. And another factor that's kind of driving a lot of activity or expected activity right now is with the new administration coming on board and potential tax changes, and many have been looking to do, and if they are considering an exit or some sort of liquidity event, many of our trying take advantage of that prior to any type of capital gains tax changes. It's funny enough, even last year in the second half, that was a motivating factor for many buyers because they were again worried about the results of the election, and they were clamoring to want to kind of exit. And I've heard of situations where there were even bonuses that were offered, incentives that are offered if you could close before the end of the year. Now, New Year rolls in. We've got a new administration. Again, people have that kind of tax change fears, and again, that's helping drive some of the volume activity, particularly in privately held businesses. And then also, I think what we're starting to see is basically, an aging of the population. You've got a lot of business owners who are getting close to retirement age. Oftentimes, they don't have a next generation to kind of hand over the business to, and many of them had experienced this, the challenges and difficulties during the pandemic time, and many of them just have gotten a little bit tired and looking for potential exit. I had one client who, prior to the pandemic, was looking for an investor, but at that time, a majority investor was out of the question. He still wanted to maintain control and everything. Post-pandemic, his view has softened a little bit, where he experienced a lot of the challenges of that environment, and he definitely had been open to alternatives versus prior to COVID. And then again, the following bullet points, continue to have a very favorable environment in terms of interest rates, business sentiment, and available capital. And we really do expect to see, I think, a pretty attractive market continuing. And certainly, if anyone in the audience is considering even whether it's a full or a partial sale or investor for the business, certainly now is a very active time, because this definitely is a seller's market environment. If this goes to the next polling question.
Perfect. I will launch that one. What is the most important factor to achieve a competitive premium value in a sale of a company? Growth, profitability, customers, or the sales process? I'm going to leave this up. Oh, go ahead, Joe.
I was just going to say, well, while people are answering that, I think just from a quick time check, John, we'll give you another maybe 3 or 4 minutes. And then for the rest of the group, if you have any questions, please throw them into the chat. We may end up doing questions for both John and Steve at the end, but send them over.
Thank you, Joe. I'm now sharing the results. So John, do you want to comment on those?
Sure. Well, yeah, I'll comment on that as I go through the slides. I'll go through the slides pretty quickly.
Sounds good.
So I think many of you in the audience, you're operators or business owners. So I think you already know what are the characteristics of a good company. And oftentimes those are the same characteristics in terms of what generates a high valuation multiple. Having a strong business model, attractive growth opportunities, having a large addressable market, having a favorable defensible position, and so forth. Overall, the factors that make for a good company contribute to being able to kind of get the highest valuation multiple. And these are some of the, I think, more details and examples to it. But speaking for me personally, I believe running a robust sale process is one of the most, I think, important factors. And I say that because a business basically is only worth as much as someone's really willing to pay for it, right? So no matter how attractive and how pretty the business is, if you don't bring the right buyers to the table and having these buyers kind of competing for these assets, I think you're not going to get the most favorable outcome for you. And that's why oftentimes, hiring a professional and having them have that burden to kind of, again, take advantage of the market environment and find the right buyers and bring them to the table. I think it's a attractive option in terms of trying to achieve the favorable valuation that they're looking for. And this last slide is basically just a quick summary of the typical auction process that I think many investment bankers run. And this is a sale process that typically takes from beginning to end about 7 months. And again, it's about creating that buzz, creating that competitive tension where you want to find the right buyers that makes a good buyer or a good strategic fit for that particular investment opportunity, and then again, kind of creating that tension, if you will, to have many of them kind of operate each other. So I'll wrap up my section with a recent real life example. So I had a client where it had many favorable factors for the business, having good steady growth, having very good attractive profit margins with a very diverse and kind of very much blue chip client base in the business services sector. And basically, we were hired as an advisor. We ran a sale process, and we ended up actually closing at a valuation which is basically 2 times what we had expected. And partly was because, again, we found the right buyers and who very much saw the value in this business being a good fit for their existing operating model. And we ended up having where I think ultimately the ultimate buyer ended up increasing his offer by close to 30% and saying basically, hey, we want to short circuit this process rather than kind of going through that 2-step of having an indication and then LOI. We'll give you the LOI now if you give us exclusivity and we work towards closing. So we ended up actually closing this deal less than 6 months with a very favorable valuation. So again, being able to run a very robust process is a very important factor in terms of as business owners being able to achieve the desired results.
Before we jump over to Steve, you just hit on a point. It seems like the more and more deals that I'm involved in, the more I see somebody trying to circumvent the process, right? Multiples continue to increase. It's more and more competitive. Do you have that same feeling that, if you're running a competitive process with the right partner and you're getting the right eyeballs on a deal, that you're going to have at least 1 or 2 that try and circumvent it and get in there ahead of everybody else?
Absolutely. And oftentimes that ends up being kind of a strategic buyer because, for them, the synergies and their strategic outlook tend to be a little bit different than some of the private equity firms. Now, you also, in between those 2 type of buyers, you also have kind of what I would consider the quasi, where it's a platform business backed by a private equity firm that, again, is in that aggressive growth stage. So absolutely, we see that. And, what I've also heard from some of the financial buyers is that, during the early part of this year, a lot of them have said that they need to kind of change their mindset because basically they were being outbid by other buyers in these processes, and they just weren't getting a lot of traction. And they've said that basically they were thinking kind of like pre-pandemic, and that's not working now because again the competitive market right now is so high that they said that basically we need to kind of change our mindset in terms of how we bid for these businesses.
It's interesting. I was involved in one transaction that was very much part of the discussion from the sell side of, hey, we got to create some buzz. One way to do that is to maybe hint here and there that there may be a way to preempt this and see if somebody bites at it. So thank you very much, John. That was very insightful. I think you hit on a bunch of things that were right on point, just in terms of the entire, 2020 versus 2021 and the urgency around taxes. Because of the uncertainty in changing presidents. So Speaking of tax, I think that's a great segue. Steve, I know you are going to be talking about some recent tax updates. So without further ado, I'll turn it over to you.
Thanks. And can you see my screen?
Yep. Actually, and Roseanne, I apologize. Did we want to do a quick polling question to keep us on track? Sorry, Steve.
Yeah, that's okay. Yes, let's do that quick, just to make sure that we have everybody that's looking for CPE able to get all their questions answered. So what was the average EBITDA purchase multiple in 2020 for companies valued between 25 million and 50 million? 7x, 8x, 9x, 10x.
Now, everybody should know this if they were paying attention, right, John?
That's right.
Absolutely.
It's a good thing we're not graded and for CPE purposes.
All right, and I'm going to share this just very quickly, and then we'll move on to the rest of the presentation. So it looks like 36% said 9x. So I see Joe nodding his head. Is that correct, John? Is that the right answer?
Yes and no, because it was actually 9.9, a little bit under 10. So if you round up 10, if you round down 9.
All right, perfect.
I thought it was 9.3. Shame on me.
9.3.
Everybody's a winner. That's all right. Good. Thank you. All right, Steve.
Great. Good morning, everyone. My name is Steve McCullough. I work at BDO, and I'm a tax partner in our transaction advisory services practice. My practice focuses on buy-side and sell-side tax due diligence, tax structuring, and tax modeling. And I work closely with my counterparts on the quality of earnings or financial due diligence side on most transactions. I just want to spend a couple minutes talking about some of the trends I'm seeing in transaction advisory services. Like our two prior speakers, I'm seeing heavy volume in the M&A world. And the volume is so high that I'm seeing opportunities being turned down left and right by some of my counterparts on the financial due diligence side. And so I make that comment because to the extent you're going to participate in a transaction and you're going to need to line up advisors, particularly on the quality of earnings side, you're going to want to reach out to them well in advance of a transaction so that they can get you in their queue and in their pipeline and can service your needs when the time comes. Because what we're seeing left and right is people call my counterparts and want them to jump into a transaction tomorrow, and there's just not enough people in the system to work on these transactions in a moment's notice. And I think one of the reasons that is happening is we're seeing this huge uptick with respect to sell-side services. So historically, transaction advisory services professionals were serving buyers on the buy side, but now we're seeing a huge sell-side need as well. And so now you have these professionals not only representing or working on the buy side, but also representing and working on the sell side. And we're seeing sell side quality of earnings used on, I'd say 90+% of the transactions we're working on these days. And we're also seeing an uptick in the desire for sell side tax due diligence, particularly with respect to sales tax. And I'm going to spend a couple minutes on a future slide talking about why sales tax is so relevant. But in practice, we're seeing, depending on the industry, sales tax becoming a major issue with 7-figure levels of sales tax exposure. And you just don't want this type of exposure popping up last second when a buy-side team is coming in and performing their due diligence. So we're seeing more and more sellers want to proactively understand whether they have a sales tax exposure, quantify what that exposure may be, and then they can proactively deal with it when a buy-side team comes in and inevitably raises the same issue. COVID is obviously a hot topic in the quality of earnings world. I know there's constant debate with respect to EBITDA adjustments, whether they're adjustments with respect to the shutdown event or whether they're adjustments with respect to the business model impact. The EBITDA adjustments with respect to COVID can really vary all over the board depending on the industry. I was talking to my counterparts that work, or I guess practice in that area. What they've been seeing in practice is in the manufacturing industry, there was a slowdown for several months, but then a quick uptick several months later. And so when they view some of these businesses on a trailing 12-month perspective, it tends to be a net wash. Some of these other industries, though, like the restaurant industry, has been hard hit. And so when they deal with some of these EBITDA adjustments, they're focusing on, how some of these restaurants performed prior to the pandemic. PPP loans is another interesting topic that comes up on most of our transactions. What we see time and time again is that people expect the PPP loan to be forgiven. They're in the process of getting it forgiven, but then transactions close before that forgiveness is achieved. And we're seeing on most transactions cash being placed aside in escrow, and then that cash will be released from the escrow once the PPP loan is officially forgiven. On the tax side, with respect to the PPP loans, the PPP loan in and of itself is not taxable, so it does not contribute to taxable income. And when it's forgiven, the expenses used by the PPP loan are in fact deductible from an income tax perspective. And then the last trend, we're seeing more and more rep and warranty insurance on transactions. Typically, when rep and warranty insurance started, we were seeing it on some of the larger transactions, but we're seeing it more and more frequently on smaller transactions. And what we're also seeing too is the rep and warranty insurers doing more thorough due diligence on the due diligence providers. So if a client engaged me to perform buy-side tax due diligence, I would often join these rep and warranty insurance calls, and it was clear to me that the rep and warranty insurer that was interviewing me really didn't know that much about tax. They were just asking generic questions and essentially checking boxes. But as we see these rep and warranty insurance policies get more and more sophisticated, the insurers are hiring more and more sophisticated people to interview me and other due diligence providers. And so now what I see is I join these rep and warranty insurance calls, and whoever's interviewing me really read my report, put a lot of thought into it, clearly has some tax background and expertise, and is really grilling me and asking me really good questions to make sure that I did a good job with respect to my services. So that's another trend we're seeing, is we're seeing more and more rep and warranty insurance. We're seeing it more frequently on smaller deals, and we're seeing these insurers engage more sophisticated people to perform due diligence on the due diligence providers themselves.
Hey, Steve, it's Joe. I would echo all of that. A lot deeper diligence, a lot more follow-up, a lot more, hey, you guys got to go clear this. And I would also add that I think it's heightened and elevated the sophistication and quality of due diligence. Having that second set of eyes that you're going to get poked at, just gives you one more reason to go back and push the seller or management to go get the details and from a tax standpoint, insurance standpoint, whatever. So shameless plug, we've got a reps and warranties insurance update next Wednesday that I'll be leading, but those were all right on point, Steve.
Yep. Okay. So with respect to sales tax, again, this is a hot topic in the due diligence world. I think a lot of companies just don't have their arms around their sales tax compliance needs. I think there's still this misnomer out there that you don't have to deal with sales tax if you don't have a physical presence in a specific state. And that's just not the case. Subsequent to the South Dakota versus Wayfair Supreme Court decision, there's now this concept of economic nexus in almost every state in the country. And companies really need to focus on whether they have economic nexus in these jurisdictions. And if they do, make sure they're compliant with all their sales tax requirements. Economic nexus can just be triggered by the number of transactions in a specific year, or it can be triggered by the amount of revenue generated by customers in a specific state. I know more and more companies are hiring firms like Avalara to help with sales tax compliance implementation. And like I said, this is a big topic on a lot of transactions with some significant exposure dollars. Another topic that's coming up quite frequently on transactions is what people refer to as Section 1202. This is the qualified small business stock provision in the Internal Revenue Code. Now, this is not a new topic. This has been around for years and years and years. And as we show here on the slide, gain from a sale with respect to Section 1202 is 100% excludable from tax anytime after September 27th of 2010. So this is not a new provision in the Internal Revenue Code, but it's getting a lot more attention, I think, for two reasons. The first reason is we're seeing more and more businesses file as a C corporation. And we're seeing that more frequently because the corporate income tax rate has now gone down from 35% to 21%. So the entity level income tax rate that applies to C corporations is not nearly as bad as it has historically been. The second reason we're seeing more interest with respect to Section 1202 is just concerns about capital gains rates going up in the future. And so if you can create a business or form a business and operate in C corporation form, and then sell that business, you can potentially avoid capital gain. And again, that capital gain that's excludable is up to 100% with respect to transactions after September 27th of 2010. Now, when I work on transactions, you know, and we think about investment opportunities, I will say more and more of my clients are interested in doing the investment in a C corporation structure to potentially take advantage of Section 1202. The amount of exclusion that can apply is the greater of $10 million or 10 times the taxpayer's aggregate adjusted basis. So if your aggregate adjusted basis is a big number, 10 times that big number is a huge opportunity to exclude gain. There are a variety of requirements. So like anything in the Internal Revenue Code, you got to look at the devil of the details. Businesses' assets cannot exceed $50 million worth of value. The stock that you receive needs to be originally issued by the C corporation. Only certain businesses or trades can qualify for Section 1202. And then when you think about the private equity community, you do need to hold your investment for greater than 5 years. As far as we've heard, the Biden administration does not have any plans at this time to get rid of Section 1202. So again, this seems like a great opportunity if the facts align themselves. Okay, Roseanne, do you want to do another polling question?
Yep, this will be the last one. So it's my level of tax knowledge is as follows. I don't know anything and I don't want to know anything. I know enough to complete my own personal individual income tax return. That's it. I know enough to be dangerous and I keep an eye on the rules and regulations, and I specialize in tax.
So while people are answering that, I know we're going to be a little crunched for time, so I figured one question came in, Steve. Mm-hmm. When you're talking about pre-sale due diligence, what's the ideal timing to have that done in advance? Is it 6, 12, 18 months?
I'd say pre-sale due diligence, at least 6 months in advance, at least. We're not seeing people engage service providers, prior to 6 months in general.
Yeah, and that kind of syncs up with John's slide that when you're running a process, you kind of need to start it and kick it off 6 months prior. So I suppose it could, in my experience, sync up right before that or kind of in conjunction with that.
Yeah. And, if you're going to sell a business and you're going to think about engaging a sell-side investment banker, you want to have that be part of the conversation with respect to when should we start engaging sell-side diligence providers. and make sure that timeline aligns with the sell side investment bankers' expectations.
All right, I think we got just about 5 minutes left, and I know you have a few slides.
Yeah. So just a couple other tax topics relevant to M&A. Net operating losses. The rules have changed slightly prior to and subsequent to the TCJA. And then the CARES Act also slightly changed how the tax rules work with respect to net operating losses as well. I think the long and short of it is, subsequent to the TCJA, carrybacks are now disallowed. Carry forwards can be carried forward indefinitely, but those carry forwards can only be used to offset 80% of taxable income. And then, people probably are familiar with the interest expense limitation rules that came into play several years ago. I think what's interesting here on this slide is that the limitation has generally been 30% of EBITDA, and it will remain 30% of EBITDA through the end of 2021. But starting in January in 2022, the 30% limitation now applies to EBIT. And so that's a little bit more punitive from a tax perspective. And what we show here on this slide is just a numeric example where your 30% limitation through 2021 would be about $600,000 in this scenario. And then starting in 2022, the interest expense limitation is 30% of EBIT. And so that would drop to $450,000 in this example. So the interest tax shield that has historically been available when leveraging companies isn't going to be as readily available starting in 2022, given the limitation applying to EBIT and not EBITDA. And then just the last topic that we see in the tax world come up frequently on M&A transactions is the concept of bonus depreciation. Bonus depreciation allows a buyer to write off or expense 100% of purchase price that's allocated to qualified property. So if you think about a deal structured as an asset deal, or perhaps a deal that's a stock deal with a 338(h)(10) election, any purchase price that's allocated to certain qualified property is eligible for bonus depreciation. Now, the bonus depreciation, which again is 100% expensing, is under current laws going to be gradually reduced for property purchased or placed in service after December 31st, 2022 and before January 1st, 2027. So it's going to be a gradual tick down from 100% to 80% to 60% to 40% to 20%. And then after January 1st, 2027, under current tax rules, bonus depreciation will no longer be relevant. Again, I think the key concept here is bonus depreciation can apply to both new and used property. So again, in the M&A world, if you're buying property in an asset deal, people are taking advantage of bonus depreciation. I think with that, that concludes the accounting and tax update.
Okay, I didn't see any other questions come in. If anybody has any questions, we've got maybe just 1 or 2 minutes left. Otherwise, I'd like to thank all the speakers, Steve, John, Alan. Great job in pulling the slides and the presentation together. So thanks, everybody. Thank you for all the members that participated. I think we'll wrap it up here.
All right. Thank you, everybody. Have a great day.
Thanks, everybody.
Thank you.